Hello, financial enthusiasts. Welcome back to our channel. If you're new here, don't forget to hit the subscribe button and give this video a thumbs up. Today, we're setting sail on a voyage to explore the intriguing topic of investing during times of inflation. We'll be unfolding the concept of inflation, shedding light on its intricate workings and how it affects the world of finance and investments. We will then delve into the fascinating debate between growth stocks and dividend stocks. Which one fares better during inflation? Is there a clear winner, or does it all boil down to individual investor strategies and market conditions? These are just a few of the questions we'll be tackling in this video. So buckle up as we dive into the world of finance and investments and navigate through the stormy seas of inflation. First things first, we need to understand what we're dealing with. So what exactly is inflation? Well, imagine going to your favorite coffee shop and finding out that the price of your beloved latte has gone up by a few cents. Or picturing yourself at the grocery store and realizing that the cost of your weekly shopping has increased slightly. That, my friends, is inflation in action. Inflation is essentially the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. Think of it as a silent thief, slowly but surely eroding the value of your money. But how do economists measure this elusive concept? They use something called a consumer price index, or CPI for short. This index tracks the price of a basket of commonly used goods and services over time. When the cost of this basket increases, we say that inflation is occurring. Now, inflation is not entirely a villain. A moderate level of inflation is actually considered healthy for the economy. It spurs consumption and investment, which in turn fuels economic growth. However, when inflation rates soar too high, they can create uncertainty, hinder economic stability, and erode your purchasing power. So how does all of this affect your hard-earned money and your investment decisions? Well, that's a great question. Now that we understand what inflation is and how it affects the economy, let's see how it impacts our investments. Inflation is like a silent thief, slowly eroding the value of your investments. But how does this happen? Let's delve into this crucial financial phenomenon. Inflation is the general increase in prices over time. As the cost of goods and services rises, the purchasing power of your money decreases. This means that the same amount of money will buy fewer items in the future compared to today. For investors, this is a significant concern. Imagine you invested $1,000 with an annual return of 5%. After a year, you'd have $1,050. But if inflation is at 2%, the purchasing power of that $1,050 would be equivalent to just $1,030 today. So even though your investment has grown in nominal terms, in real terms, it's lost value due to inflation. This is known as the erosion of returns. Over time, inflation can significantly reduce the real value of your returns, especially if your investments are not keeping pace with or exceeding inflation. So, when planning your investment strategy, it's essential to consider the impact of inflation. Look for investments that have the potential to outperform inflation. This might include assets like stocks, which historically have offered higher returns over the long term. It's clear that inflation can have a significant impact on our investments. But does the type of investment matter? Do growth stocks perform better than dividend stocks during inflation? Let's explore this in the next segment. Growth stocks or dividend stocks, which one fares better during inflation? Let's find out. During inflationary times, growth stocks, which are shares in companies expected to grow at an above-average rate, may offer more potential for return. This is because these companies often reinvest profits back into the business to fuel further growth, making them less susceptible to the eroding effects of inflation. On the other hand, we have dividend stocks. These are shares in companies that pay out a portion of their earnings to shareholders, usually in the form of cash dividends. While these regular payouts can provide a steady income stream, they may not keep up with inflation if the rate is high. So, is one better than the other? Not necessarily. The optimal choice depends on your individual financial goals, risk tolerance, and investment horizon. So there you have it, financial enthusiasts. Inflation is indeed a factor to consider in your investment strategy. Remember, knowledge is power, and in this case, it could also mean more money in your pocket. Until next time, keep investing smartly.